Good morning. We're here to talk about the Silicon Valley real estate market ending the week of August the 8th, presented Saturday morning, August 9th. These are the key chapters that we're going to be going over. There's a timestamp in the YouTube description below. You can jump to the sections you find most interesting. Let's get into the first data slide. I do want to point out that this number has been changed up here from last week. I had an error in my formula. I had an EL instead of a BL. It was my eyesight, so it's now corrected. It makes a lot more sense. But anyway, these are the different metrics. The metrics are across the top here. The green are comparing to the 10-year median. So you're taking today's value for this week and comparing to the same week for the previous 10 years and doing a ratio to the median, and then saying if whether it's more favoring the buyer than normal or more favoring than the seller than normal. So when you look at Silicon Valley overall, in Santa Clara County's on the top, San Mateo is in the middle, Alameda's in the bottom. But when you look overall, it's very blue. That tends to indicate that the market's favoring the buyer more than it typically does. But now if you move over and look at the yellow, this is sort of what the metric is right now. And so even though we're saying it favors the buyer more than it typically does, for example, let's look at Silicon Valley. For us to sell out our entire inventory in 52 days, that's still a fast marketplace. For 3 out of 4 sellers to sell their home in 36 days, basically 5 weeks, that's fairly fast. For the average seller to only do a 1.6% price reduction, although that is more than normal, that is still fairly small price reduction. For only 22% of the sellers to be doing any price adjustment is pretty small. That's only 1 in 5 sellers. That means 4 out of 5 sellers make no price adjustments at all. The average overbid is 3.3% above the seller's ask price, with 53% of the sellers receiving more than their ask price. So my point is this: the conditions are still a good marketplace, but it's much slower pace than it typically is. So Silicon Valley is normally like a raging bonfire, and now we just have a fire. So it's still fast paced, but a lot slower than normal. Anyway, you can look at the micro market areas. 7 is in Santa Clara County. San Mateo County only has 6, and Alameda County has 7, giving me 20 micro markets within Silicon Valley. Here is one of the key things that I've been tracking. And I started this because of the tariff talk. And the tariff talk, basically back here at the end of first quarter, beginning of second quarter, really has had no impact on the volume of sales that I'm detecting. But what this is a leading indicator. It shows how many sales you've had in the past week compared to normal. And normal would be the gray line, since you're essentially right on the blue line. And we've been essentially right on the blue line for the last 3 years. We're missing something like 25% of the marketplace. We're having the least number of offers accepted that you would expect in each given week, but there doesn't seem to be any change. So there's a lot fewer transactions for the real estate industry as a whole, but the market keeps on moving. Now here's the past quarter. This week is in the center of the graph. I don't have the purple line, which is the current data, into the future because I'm not a mind reader. I do have the trend lines going into the future because we know what happened in the future week for the past 10 years. The past 10 years are 2015 through 2024. Those are all in the book. So we know what the trend line is. So now you know which direction the purple line is likely to go. You come back for 13 weeks, which is a full quarter, and these are what the raw count was up here, and then the percent of normal. So we had 35% more inventory than we normally do. And despite the Mercury saying that inventory was continuing to grow, and I think that was only 2 weeks ago, you can see the real change in inventory happened about 6 weeks ago. And we now have 99% of our expected inventory. So we have exactly, or at least close enough for me to call it exactly the right number of active listings. So there's no longer a surplus of inventory like there was back in May, because, well, basically the month of July was the correction. So most of the month of June and the month of May, we had more inventory than we should have had, but not outrageously more. It was still fairly close to the blue line. The blue line is sort of the most inventory you'd expect. So anyway, there's currently 28 inventory right now in the 3 counties that are making up Silicon Valley. And then moving on to offers accepted. You can see a quarter ago, we were accepting 2,150 offers. We're now down to 1,900. Yes, that's a slowing, but the market normally slows. So look at the percentage of normal. You were only at 74% of normal, and now you're almost at 76. So it's about a 1.5% improvement in the volume of transactions. So we've had a reduction in the inventory compared to normal and a slight increase in the number of offers compared to normal. Now, keep in mind, the peak of the marketplace is typically, as far as offers accepted, is typically the 5 weeks before Memorial Day, which is why the inventory, the number of offers is going down. So this is a completely normal trend, and that's supported by the fact that the percentage has gone up, even though the raw count has gone down. Number of transactions is just on there because that's what the industry gets paid on. It's a little surprising that it doesn't match the number of offers a little more closely, but we started off at 80% of the closings that you'd expect, and we're now down to 72% of the closings you'd expect. Days unsold inventory is the seller-buyer balance, the supply-demand balance. It's a theoretical number. It tells you how quickly the market's turning over. We were at 52 days. We're now at 51.7, so a slight improvement. But look at percentage of normal. You were 172%, so you're 72% slower than you normally are, and now you're only 27% slower than you normally are. So we're almost, even though the market is slowing down, normal trend is for the market to slow down. So we're catching up. Basically, you can see it another way. See the purple line? Look at how much above the gray line it is. Very much above the gray line. And in the last couple of weeks, notice how the gray line's been catching up to the purple line. The purple line's fairly flat, but the gray line's been catching up. That's why the percentage has been decreasing. So we're getting closer to where we normally are for this time of the year, but we're still quite a bit slower because you're above the blue line than you'd expect to be. Marketing time. This is an easier concept for the consumer to understand. And this is the one that's had a time shift in it. And I don't understand that, but it is what it is. You basically had the slowdown because notice how the purple line comes up. Look at the gray line. The gray line comes up, but normally the gray line's flat to about here, and then it starts increasing. So anyway, the increase happened earlier, and now the blue line is sort of catching up, but the purple line is still going up at a faster rate. It's sort of like the purple line's down over here, where the blue line does get steeper. So here you've actually had a slight deterioration. You've gone from 147% of normal to 153%. So a slight slowing. But again, you have to keep in mind that 3/4 of your sellers are selling in 36 days. Now, typically that's only 24. So we're 50% longer than what it typically is. And we're almost the same, 27 days. That's probably what, 1.4 times slower now at 36. Let's see, 9 goes into that about 3 times, and it goes into there about 4. So it's about 75% slower than the longest time. So we're clearly taking longer time. The average property is taking longer to sell. Ask price reductions. This is sort of a measure between the seller's expectations when they put the house on the market and the market realities. A quarter ago, we were taking 0.9% price reduction, and that number is very small, and it typically is very small in Silicon Valley because only a small percentage of the sellers do a price reductions. But even though that was small, it was 2.5 times greater than it normally is. So doing some math on the fly, maybe it's something like normally 35%, 0.3% price reduction, and then you do 2.5 times that, and you get up close to 0.9%. Now you come over here, and we're taking 1.5% price reductions. So you're taking much larger price reductions, but the percentage of normal is getting much smaller. It's only 1.5 times more than normal. So you can see that the purple line had been below the blue line, significantly below the gray line. And in the last, little time here, it's crossed over the blue line, and it's now between the blue line and the gray line. So again, it's still worse than it typically is for sellers, better for the buyers, but it's still not bad when you consider on how small those price changes are. Now we're looking at overbidding. Overbidding is an indication of how competitive buyers feel when they're making the offer. They found their house they want, they're making their offer, there's competition, how much do they have to overbid? Typically, a quarter ago, you were at 7.6%, we were only at 6.9%. That's pretty close together. To get 7% over your asking price, you're close. And you can see the gray line and the blue line were pretty close together. But just 1 week later, it started really dropping off. And now we're only getting 3.3% overbids when you're typically at 6% overbidding. So the magnitude of the overbidding is half of what it typically is. So overbidding is still happening. It's just a lower magnitude. Now what we're doing is we're looking at the three key indicators over a long period of time. We're going all the way back to January 1st, 2015 over here on the left-hand side. And we're looking at a condensed scale up until January 1st of 2024, where we go to the expanded scale. And that's so you can see current trends. The purple line is inventory. So you can see that inventory grew all this year until about halfway through second quarter. Starting halfway through second quarter, which is basically middle of April, inventory was actually dropping to compare to normal. Last week we got below normal. This week we actually had a slight increase, but we're still below normal. Yes, I would call it absolutely normal. You have a fluctuation in any marketplace. Then moving down to the orange line, which is your number of offers, you can see you're only about 75%. But notice you've been at that level basically since about fourth quarter of 2022. So all of 2023, all of 2024, the first half of 2025, and the last portion of 2022 have all been this reduced number of sales. And it's been around 25%, missing around 75% of the volume you expect. In 2023, it was maybe 70%. You went up to maybe 80% during the good times. And now we're back down to right around 75%. You can see the impact of when shelter in place happened with COVID, when we couldn't show properties. And then you can see the surplus, the transactions, which was a greater magnitude. But, if you average this out, it's only 25% more. We're losing 25%. This was only for basically, even if you want to be generous, a year and a half. So now we've lost the same amount for twice as long. And it's also interesting, there's been a general trend for there to be less and less offers over a very long period of time. And I'm talking about going back to when I first got licensed in the early 80s. We used to have more transactions, and the number's been going down all the time. It doesn't make sense when you have a growing population, other than there's a lot of sellers that are locked in because of capital gains tax, even though there's the $250 exclusion per person in the Bay Area. Most people that have had their property for any length of time are way over that exclusion. And if they're looking at a $500,000 tax bill, which is not uncommon in this valley, they're going to stay put. And so we're having people stay longer and longer in their houses, causing an inefficiency use of the existing housing stock. Now we're moving on to the final number, the days of unsold inventory, which is the seller-buyer demand ratio. And you can see that we're a higher number. You're about 28% above or 25% above where you are. That means the market is slower. In this particular case, it's because we're having 25% slower number of offers. And this is the balance. So if inventory goes up, days of unsold inventory increases. If the number of offers goes down, days of unsold inventory increases. So it's impacted by both. It's the ratio, and that's supply and demand, and that's what drives the free economy in a capitalist society. Now we're going to look at Silicon Valley long-term, comparing it to the track record. So this is the most inventory, the favor the buyer the most, the blue line. The gray line is where you'd expect the market to be. The purple line is the current data, and the red line is the least number of active inventory you'd expect favoring the seller. So you can start at the beginning of the year. You can see we started off right with a very limited supply of inventory. That occurred about halfway through fourth quarter of 2024. We rapidly grew during first quarter. We continue to grow in inventory in the second quarter beginning, but the second quarter beginning was basically or first half was basically keeping up with the normal rate of growth. But then we had the plateau. The plateau was much more condensed, and we've been dropping off. The drop off typically doesn't happen until fourth quarter, and yet the drop off happened fourth quarter. Clearly, the drop off happened at the beginning of third quarter, and we're back down to the normal level of inventory. Here's compared to normal, so you can see that we had quite a bit more inventory than normal. This is on a percentage basis, and now you're right back to the normal level. Doing the same thing with offers, you can come back and look and see. Before the pandemic, we were basically having normal number of offers. We came in and we had the pandemic. We were, having a good year right at the normal. Here's the shelter in place order, huge drop, rebounded, made up for the lost activity, had surplus number of offers because everybody's housing needs changed. And then in 2022, you can see early in the year, you can see this number of offers start dropping like a balloon. The peak of the 2022 marketplace, based on other data, really was around Valentine's Day, and that's corresponds where the peak of the marketplace was in 2025. So you can see in 2025, you started off cool, less offers than normal, came up, almost got halfway in between normal and less than normal. And then you come over and now you're back on the less than normal trend. And you got to be careful because Easter's in here, which pulls down the least number of offers you'd expect. Here's based on a percentage basis. And again, you can see that we've been somewhere right around 25%. Yeah, maybe we were missing 30%, maybe we're only missing 20%. But right now we're sort of back at that 25%. And you can see there's fluctuation in all this data because it's live data that's updated every week. Here's the days unsold inventory. This tells you the turnover rate. You can see in 2024, we were basically having a normal turnover rate. Started off normal in 2025, went up and got slower than normal, stayed that way through the first half of the first quarter, and then it abruptly changed and got quite a bit slower. So since halfway through first quarter, we've been quite a bit slower than the slowest you'd expect, because the blue line's the slowest you'd expect based on the past 10 years. And now you're slower than that. So that's why it's more of a buyer's marketplace right now. Here's compared to normal. So you can see you're about 25%, maybe 28% slower than normal. Quite a bit better than we were earlier this year. Right at halfway through second quarter was the slowest marketplace. And that's when I had to actually expand the graph. I had cut this off at 170% because the only time we were above that was for the pandemic shelter in place. So that gives you some idea of how slow 70% slower than normal normally is. Here's marketing time. How long is it taking 3 out of 4 sellers to sell their properties? Here's the time shift. Notice the flat plateau on the purple line happened at the end of 2024. Normally it happens halfway through the first quarter. And you can go back and look at the graphs and you can see it's very consistently, the gray line, halfway through first quarter. And even the purple, the raw data for each individual year, is halfway through first quarter. There's this time shift. Now look at the bottom. You have a time shift now of a full quarter. And even the steeper cliff looks like it happens right through here. It happened here. Again, it looks closer to half a quarter early. Now you're already plateauing. Here you're almost, the plateau is out here. You're almost a full quarter ahead. I don't understand why the marketing time is shifting like that. You can go back and look yourself over the past 10 years. I have not been able to find a horizontal time shift on this, moving things earlier in the year. Real estate's very cyclical based on social needs, holidays, school calendars, and to have a time shift like that is just something that I've not seen before. And it's interesting. I'm watching it. It's not doing anything unusual other than there's a shift in the pattern. Here's that pattern on a percentage basis. And here's where you can start seeing marketing time started to increase here. That's not Valentine's Day, but that's probably more like March 1st. And you can see it's just started climbing. You can see in 2025, right at about the same point, started climbing. Now we've clearly turned around and we're coming back down, but we're still at record long marketing times. We're 50% longer than we typically are. And you can see the only time we were above that was during the shelter in place time frame when we couldn't show properties. So this is significant, but again, when you look at the raw counts, I forgot what the number was. I think it's 36 days for 3 out of 4 sellers to sell. Anywhere else in the country, they consider 3 to 7 months normal. We just are spoiled here in Silicon Valley. Here's now looking at the sellers that are taking the largest price reductions. How much are they taking? So the sellers that are taking the largest price reductions are only getting 86% of their original ask price, which means they take a 14% price reduction. That's in line with what the most you'd expect. Typical would be up here somewhere around 11% price reduction. The reason the average is so small is the vast majority of sellers paying no price adjustment at all. And here's compared to normal. So you can see earlier this year, we were taking very large price reductions. The only time we were taking larger was after the market collapsed in 2022. We're now sort of at the high end of what would be reasonably to expect in Silicon Valley. Here now is looking at the average. I don't like this because the numbers are so small. And here you can see the average price reduction is only 1.6%. It really doesn't paint a true picture. The typical seller doesn't do any price reduction at all. What is it? 78% of the sellers right now in the slower pace marketplace for Silicon Valley aren't doing any price reduction. It's only 22% that are. That's why the 10% that are taking the largest is way up there. I forgot what the number was, 14% price reduction or whatever. Here, when you take in all those that are not making any price adjustment at all, you're only at 1.6%. I include this more just to show you they're related. And here you can see your price reductions are greater than they typically are. Here's the frequency of those price reductions, and you can see that we are at 22% of the sellers are doing price reductions. Notice it turned over and came down a little bit. No way of knowing whether it's going to continue. We normally climb for a little bit longer in the year, but you can sort of see the flat toe here came in maybe a little bit early, but it could bounce around and go back up next week. Here's on a percentage basis. So on a percentage basis, you're clearly improving, and you're improving quite a bit, and that's because the normal time of the year, the price reductions are actually increasing, and this year, for whatever reason, they're decreasing slightly. Here's the magnitude of overbidding. This is the median. So half the buyers are paying over ask price, which I think it was 53%, but it's just about 0.5% over. I also have the average at different times, that 3.3%, that's the average overbid, and the average gets pulled over because there's no cap. So right now we're 2.5%, 2.75% less overbidding than normal. So if I remember the numbers correctly, if the 3.3% overbidding now, you add in 2.75% onto that, you're basically, normally the overbidding would be about 6%. If you were on the gray line, you'd be hitting exactly the amount of overbidding you'd expect. Here's the frequency of overbidding, and you can see you're 53% overbidding, which is less than you'd expect. It's less than typical. Typical is up here around 68% or 60, real close to 68%, 67%, 2/3 of the sellers. And now you're only at half the sellers are getting more than their asking price. But frankly, on big ticket items, historically, you negotiated the price down, not up. Here's on a percentage, the frequency on a percentage basis. So you can see that we're only selling about 78% of the sellers are getting an overbid of what normally get overbid. So the 53% overbidding that's currently happening is 78% of the 70% it typically is. Here now is a pricing model on log paper. You can draw a straight line at 11.7% price, and that's the line you get. Or a more accurate price model would be steeper appreciation for 7 years at 12.1, well, 7.5 years, and then basically flat for the last 3 years. And that's probably a more accurate. Yeah, you had a price correction here in 2022, but you rebounded within a calendar year. You went up and you went down. This is the fluctuation. You don't want to buy at the peak, and you don't want to sell at the valley. You try to do the reverse. You try to sell close to the peak, and you want to buy close to the valley. So there's an annual cycle. And part of that annual cycle isn't property values, which is really what you want to watch. It's the areas of the market that sell, the size of the homes that sell tend to go down at the end of the year, and the values are less expensive. So the median price changes, even though property values aren't. It turns out that following the median price for a large geographical area is not a good way to track what's happening in the real estate marketplace. Here now we're starting with our first 3 distributions. This is days on marketplace. We start off at the 50 percentile, the median. That's why I don't use the median. See how close they are together? I use the 75th percentile right here. If I was to do it again, I'd probably use the 85th percentile, but you get some more movement here. The purple is the current data. We're starting off on this dotted line a year ago. We're going to step through, and this is a week at a time for the first 5 weeks. Then we jump 2 weeks at a time. So you can really see there's not much movement in the data at this time of the year typically. So you'd expect the purple line to stay about where it is. Now you're starting to move up. Right there's the longest period of time, January 3rd. And that's almost as bad on January 17th. Here's the fastest marketplace on March the 1st. and now you're starting to slow down, getting solid lines to more recent lines. We're working our way up to the purple line. You can see each week we're getting a little worse, and the recent weeks are 1 week spread. And so now you're at the current week. So what's noteworthy is the marketing time across the distribution is longer than it has been at any time in the past 52 weeks, except for right at the slowest time at the end of the year. So clearly you can see across the board it's taking longer to sell. You can see if someone came down here and said, hey, the median marketing time is only 18 days. That's pretty fast. That's accurate. And, it was only 17 days last year. So there's really no difference. But if you come up here and start looking at the 70, well, let's look at the 80 percentile. We can do this. It's about 25 days. And now actually it's closer to 30 days, get my scale right. And now you're about 42 days. That's getting to be significant. Now doing the same thing with price reductions. Purple line is the current week. We're starting off a year ago on the dotted line. You can see there really isn't much change at this time of the year. It's just sort of bouncing around, really not moving up or down. Now we're moving 2 weeks at a time. Now you're starting to, no, not yet, rushed again. Now you're slowing down. Right there's about the bottom of the marketplace. Now you're starting to rapidly improve it as we hit this New Year's. There's the hottest time of the marketplace, March 1st, and also March 15th are the same. And now you're slowing down. And that was data only every 2 weeks. So the peak was actually probably in between the March 1st and the March 15th, which would have been March 8th. Now you're slowing down. There's the coolest time coming up right there. And now we're this week. So I want to go back. Notice that there's actually an improvement from last week. The green line was last week. And there's this week. Very small, but pretty much across the board, a slight improvement in the price reductions. And then the last one is overbidding. And this one, there's a 5 week or roughly time lag because we need to get sold price. First off, notice the purple line is the worst line because the worst line is the coolest line down here, the blue, of the past 52 weeks. A year ago, we were up here on the dotted line, and we'll step through, and you can see again, there really isn't much change. And the change that you saw in the December timeframe is going to happen even later on this because this is a lagging indicator. The prices are set when the offers are negotiated. Then you have to wait for escrows to close in order to determine what those prices were. Now you can see you're starting to slow down. Now you're speeding up. There's sort of the peak of the marketplace on the 15th and the 29th. And now you're even the April 12th was even still fairly fast. Now you're slowing down rapidly. And we're going to go all the way down to the purple line. So we've got a couple more weeks, one more. And so boom, so even though it typically slows down for the end of the year holidays, the amount of overbidding that's happening now was equal to or less than it was at the holidays. Now we're breaking up the 3 counties, San Mateo County in the orange, Clara County in the blue, and Alameda County is in the gray. You can see Alameda County has basically normal inventory. Santa Clara is lagging behind. San Mateo had record high, never crossed 600 until this year. So they've recovered, more than recovered. Alameda's recovered. Only Santa Clara has a lack of inventory. Here's offers accepted. You can see Santa Clara and Alameda have roughly the same number of offers. That means Santa Clara is going to be faster paced than Alameda County. You can't do that right off the top of your head for San Mateo because the inventory size is so much difference. So here's the speed of the marketplace. Alameda County is the slowest at 58 days. San Mateo County is second at 52. And Santa Clara County is the fastest at 36 days to sell your inventory. Here's marketing time, much closer together. And that shows you that, you think these metrics would be more related than they are. Alameda County is the longest at about 37 days. Santa Clara County is about 35 days. And the fastest is actually San Mateo County at 34 days. Here's the price reductions. This one that's doing the least price reductions is Santa Clara County right up here at about 1.4% price reductions. San Mateo County at 1.5%, and Alameda County at about 1.7%. All very close together. They're very packed together on this data point throughout the last 11 years. Here's the frequency. Notice that San Mateo County is really dropping off the frequency. San Mateo County had been taking more price reductions, but now they're dropping off and they're taking the least. They're only taking, what would that be? 19% of the sellers are doing price reductions. Santa Clara County is at 22%, and Alameda County is at almost 24% of the sellers are doing price reductions. That's still only 1 in 4 for Alameda County. Here's the magnitude overbidding. Santa Clara and San Mateo County are very close together, about 2.5% overbidding. And this is very interesting. Alameda County is at about 4.5%. So even though it had the longest marketing time, the longest days of unsold inventory, it's got the most overbidding. What's happening is the sellers there in Alameda County are doing price reductions, overshooting where the market is. The buyers are coming in and now recognizing this property with 100 days on the market is a great value, and they're overbidding it because they want to get the property. So it's got the most overbidding, even though it's got the longest marketing time, which normally wouldn't go together, but I think that explains it. Here's your overbidding frequency, all right on top of one another at just about 53%. So just about half the sellers are getting more than the ask price. Also, look how close those are. Yes, there was a little bit separation in San Mateo County earlier, but that's pretty close agreement for real estate. Here's the long-term appreciation. Santa Clara County has had the best appreciation. A lot of that is associated with market mix. I need to start coming up with a better way to do it. If all of a sudden your expensive areas are doing better than your more affordable areas, your median price for that area, the county, would be increasing. And that's why this area in Santa Clara County has such a high rate of appreciation, or at least contributing to it. Here's the median sold price. You can see Santa Clara County is just below San Mateo County, the normal order, and Alameda is the more affordable at about 1.2 million. That's on log paper. Same information on regular paper. Oh, I didn't move my vertical horizontal line on Alameda County. It should be down. So you can really see the drop in the last week on price in Alameda County. Here's estimated payments using the high balance conforming loan limits for the nation. We can do better than that with jumbo money and also relationship bank pricing. Here's my micro market areas. This is active inventory. White in color says normal level of inventory. Red is a shortage. So you can see Saratoga Las Gatos is the area that has the biggest shortage. Also notice Campbell area is slightly pink on the map. It's harder to see, but you can see it a little bit in through here. Then you also have things like Pacifica up here in Daly City that are blue, which would be a surplus of inventory. Here's the offers. This is a big takeaway. Notice across the board, you have a lack of offers, bigger in some areas like Daly City, and I guess that would be Cupertino and Sunnyvale, and Saratoga Las Gatos having the least amount of offers compared to the 10-year normal, but blue across the wide area of Silicon Valley. Here's days unsold inventory compared to marketing time. And again, slower than normal. You can see Alameda County is closer to normal than the rest of the valley. Here now is just the raw count. So even though we're much slower than normal when compared to the past 10 years, when you look at the actual raw numbers, it still favors the seller because you have the fast turnover time. 31 days to sell your market, 35 days, 31 days, 29 days, 38 days. That's anything under about 6 weeks is a fairly fast-paced marketplace. Here's your marketing time. Now this is compared to the 10-year median, really blue. You're almost 3 times across the board. This number, by the way, is incorrect. It should be about 270 or something. Across the board, you're, way slower than you typically are, way long marketing time. But now look at this. Look at Cupertino Sunnyvale. 3 out of 4 sellers are selling in 13 days. That's not a slow marketplace. So it's slower than it normally is, but it's still fast paced. If you look at these, everybody in Santa Clara County is under 7 weeks. Everybody in San Mateo County, except for the expensive areas, is under 7 weeks. And everybody except for Oakland is under 7 weeks in Alameda County. That's still a reasonable time frame. That's why it's white. It's reasonable, but much slower than normal. Now you're looking at price reductions compared to the 10-year median. Here's actually becoming interesting. Some of the areas are having less price reductions than they normally do, which would favor the seller, which is why they're red. But the most is blue, and there are a few areas where the price reductions are about normal. But now when you compare to the actual numbers, yeah, it's a faint color of blue, but look at the actual raw numbers. Most of these numbers are less than a 2% price reduction, and most sellers would be happy with a 2% price reduction But what happens is the sellers do their homework, and that's why this is such a tight metric, and price their home correctly. So a 2% price reduction is still people misreading the marketplace. Here's the frequency of the price reductions. You can see some areas less common than normal. Some areas like Livermore, way more common, and Daly City, way more common. Here's the actual numbers. So Livermore is actually even high on the number. What is Livermore? Livermore is down here at a third of the sellers are doing price reductions. So that is pretty significant. Now this is overbidding. Way cooler than normal, less overbidding except for in Palo Alto. It's 3% more overbidding in Los Altos and Palo Alto. Cupertino's normal. Santa Clara County is pretty darn close to normal at 99%. But now when you look at the actual numbers, Cupertino, 7.6% overbids. Los Altos, Palo Alto, 5.5. Come down here and look at Berkeley and Alameda, 16% overbid. That's this little bright spot here, the island of Alameda. Now you look at the frequency of overbidding, way less common than it typically is because this is compared to the normal, except for right here in the San Mateo, Santa Clara County border, it's more than normal, 13% more than normal, 23% more than normal. So you can't take one brush and one number and say this is what the Bay Area or the Silicon Valley is doing. And that's the reason for the micro markets. Here's the buyers overbidding. This is the frequency. So how common is overbidding? 72% in Cupertino, 60% in Los Altos. Yes, the average is only 53%, but you got 60%, 67%, 68%, 78%. Yeah, that's almost 80% in Alameda County are overbidding. Here's the long-term appreciation. You can see the outlying areas, the areas that became more in demand with the more remote working. Livermore was red earlier and it then cooled off. Here is the prices. So now red is favoring the seller, the highest prices, blue is the lowest prices. And instead of just following the median number, which is the middle number, I also followed the 10 percentile on the left and the 90 percentile on the right. And this is a summary slide of the micro market areas that we just went over and we also started with, so I won't spend any time on it. Here's the lack of offers being accepted. You can see that the 1913 that we have right now is the second lowest, and it's been the second lowest for the last 4 weeks. So second lowest out of the last 10 years isn't as significant as the second lowest out of the last 25 years. So there's only been 1 year, which was basically 2023, where we had less transactions than we're currently having for the past 4 weeks. Here's the raw numbers for Silicon Valley, Santa Clara, San Mateo, and Alameda counties. You can see what you're looking at. I like pointing out the difference between the median, average, and 75th percentile. You can see that all of them, if you talk about the median, probably the most commonly used metric, 14 days doesn't sound that dramatic at all. But if you look at the 75th percentile, it's at 35 days, 5 weeks. So that's a lot more realistic. The advantage of the 75th percentile is to get days on market. It gets rid of the sellers that price their home to entice buyers to come in and overbid to get the bidding psyche going, the auction mentality. We have been talking about the Silicon Valley real estate. We will be talking about the Greater Bay Area, 13 counties, 5 regions next. I'm Richard Calhoun, real estate broker with Creekside Realty, servicing buyers or sellers here in Silicon Valley. The YouTube channel is the blue link up here. A shorter way to get there is what I call the green root URL. If you type in the green root URL and the year 2025, you get to the meeting Saturday mornings at 9 a.m. The handout was up. It was a little late. I got it up about 5 minutes before 9. It's the green root URL plus H for handout 2025-08-09 for the year, month, date code. And you can get to any specific episode without going through the YouTube channel by typing in the root URL, the year, month, and date of the Saturday presentation you want to listen to, or you can go to the YouTube channel and then find it that way. Appreciate any subscriptions and likes, and watch it as long as you want. Here are the 5 regions that we're going to be going over. We have the Silicon Valley, what we've talked about at length already. You have the cities, the North Bay, the Central Valley, and the Central Coast. Here's the inventory. You can see inventory is rolled over and is actually down in all areas except for the Central Coast, which is still at its high plateau for the year. The offers accepted is actually going up in the North Bay and in the Central Valley. It's probably marginally up in the cities and the Central Coast. So basically, two areas are up, two areas are flat, and Silicon Valley is seeing a decrease in the number of offers. Here's your marketing time as measured by days unsold inventory. Silicon Valley is the fastest at about 50 days. The cities is next at about 60. Then you have a two-way tie with Central Valley in the North Bay at about 85 days. And the slowest area is the Central Coast at about 97 days of unsold inventory. That is starting to be in the realm of what the balance of the country calls a normal marketplace. Here's marketing time in different order. Central Coast is not the longest. The longest is actually up here in the North Bay at 62 days. Then you have the cities at 60 days. Then you have a two-way tied for the Central Valley and the Central Coast at 56 days. And the fastest by far is Silicon Valley at 36 days of unsold inventory. This is the seller price reductions. You can see the area that's doing the least reductions is Silicon Valley at about 1.6% price reduction. Everybody else is taking greater than a 2% price reduction. And they're close enough that I would say everybody else is taking between a 2.2 and a 2.8% price reduction. So fairly close together, around 2.5% price reductions. The frequency of price reductions, Silicon Valley is doing the least frequent at 22%, followed by the cities at about 25%. Then you jump up to the Central Coast at a third. The North Bay is at about 37% of the sellers doing price reductions. And Central Valley is 2 out of 5 sellers are doing a price reduction of 40%. Here's the overbidding magnitude. The most overbidding is in the cities with almost 5.5% overbidding. Silicon Valley is next at about 3.25% overbidding. Then the other three are all below 100%. So the offers on average are coming in below the seller's asking price. First is North Bay at about a 0.25% reduction, Central Valley at about a 1 full percent price reduction, and Central Coast at about a 1.5% price reduction. They're all increasing except Central Valley, which is flat. The frequency of overbidding, basically on the downward trajectory, the most frequent tied is Silicon Valley, and the cities are basically tied at right around 53% of the sellers are getting overbid. Then you jump down to North Bay at about a third of the sellers are getting overbid. Central Valley and Central Coast are both at about 30% of the sellers are getting overbid. Here's the long-term appreciation. You can see the cities is continuing to be by far the least appreciative city. Santa Clara, Silicon Valley used to be the highest. It's come down, and now both the Central Valley and the Central Coast have higher appreciation rates than Silicon Valley. And in fourth place is the North Bay at about 64% of this appreciation since the last 9 months of 2015. Here's the median sold price for the different regions. You can see Silicon Valley is now the most expensive region. The cities has dropped down significantly in the last week. Central Coast is in between at about $1 million and 1.2 million. North Bay is getting fairly affordable at $800,000. And then the Central Valley is down around $550,000 for the median priced home. Here is the payments. You're going through the same 80% high balance conforming interest rate based on the national average. Here is looking at the different metrics across the top, the different counties, all 13 counties down the side, plus the 5 regions. I've also added in the Bay Area. I include the Bay Area only because the media talks about it so much. And to me, it's a very good indication of why one number can't do everything. If you just look at any particular metric, the range is dramatic. Let's look at today's unsold inventory. Silicon Bay Area is 67 days, but that ranges from a high of 170 days in Napa to a low of 44 days in Santa Clara County. So how you can say that 67 represents that wide of a spread is beyond me. And that's why I started doing micro-market areas. I don't even think Silicon Valley or Santa Clara County data reflects what's happening in a given area. Anyway, we have the raw count here in the now column, percent change from 1 week ago and percent change from 5 weeks ago, so you can see which direction the market's trending. And with that, again, we're back to the chapters. You can jump to the YouTube description below and jump to the chapters and the timestamps that were most appropriate for your needs. Not seeing any unmuted mics. Have a great week. Take care. Bye for now.